Okay, I'm so sorry everyone for the delay. Let's give in a couple more minutes for everyone to join in. I'm terribly sorry. We had a last night a real bad snowstorm, and because of that, we were having some technical difficulties. So thank you for standing by and waiting for us while we figure out this technology on our side. Really appreciate everyone. So let's give a couple more minutes to everyone. Um, if you can hear me well, you can see me well and see my screen well, please tell me something in the comment that you are there. I really appreciate all of you guys joining me for today. I know with the holiday season coming in, there's a lot of things going on everyone's agenda. So really appreciate this. And okay, let's give a couple more minutes for everyone to join. Oh, thank you for your comments, Mr. Nirav, Mr. Paresh. Hey, Ginny. Alrighty, well, while we are waiting on some more participants to join in, I must say that today's webinar is jam-packed with lots of good agenda. At the same time, we do have a couple other accountants as well as EAs joining in for this webinar as well. Well, I really appreciate all of you. We have our current client as well as many other business owners joining in as well. Well, without delay, let's get started. Very warm welcome to everyone who is attending this webinar with us today. And let me go over our intellectual notice, or I should say disclaimer, that the material in this presentation has been prepared by and is the property of KB Tax Devices CPAs, and all content, including images and impressions, are protected under the US intellectual property and trademark laws. Any reproduction or dissemination of any element of this presentation without prior written consent from us is expressly prohibited. Well, before taking any action based on this information, we strongly encourage that you consult with your tax professional or your accounting advisor about your specific situation. This is not a tax advice. Oftentimes, I speak to the business owners and they're like, you know what? I have a friend, or I Googled it online or in the search on the internet, and people were saying, okay, opening up an LLC in Delaware is a very good option. Well, going based on that, it's something like, taking a prescription medicine without a doctor's permission, and, consequences could be really severe. So it's exactly similar to that. Something which is suitable for someone else might not really be suitable in your situation. So you must consult a professional advisor who can guide you with all of this. Just a little bit of housekeeping. If you have any question and you want your question to be covered in the live presentation today, make sure you post your question in Q&A at the bottom of your webinar. And if you have any feedback to give us, any chat comment, you can put it in the chat box. Taruna, who is my sister as well as business partner, she will be constantly monitoring chat box as well as the comment, question and answer. So let's dive in a little bit. So today's presentation is about the current tax law of the United States versus Biden's proposed tax policy. And I'm also going to cover, let me go on the agenda first. I'm also going to cover about the current law versus proposed changes, tax rate changes that are about to be coming in, itemized deductions, tax credits, additional proposal changes, as well as ideal legal entity structures to operate in future years, and 3 tax strategies to utilize in 2020. This is something I was just feeling kind of a little bit creative, and I thought it's a Christmas time, so we should give out some gifts as well, right? I know when we announced a webinar, we didn't announce about the 3 tax strategies, but I'm just kind of feeling a little bit generous, so I'm just going to cover that as well. At the same time, a few days ago, we received another draft of the bill that is going to be released as part of the economic stimulus due to the COVID-19. So I'm going to cover that draft as well. At the same time, what to do next. So we will cover all of those areas. And for those of you who don't know who we are, a little bit about us, KB Tax Devices CPAs has been founded by two sisters, myself and Taruna. And we provide full service professional accounting services as well as the year-round advisory services. We are tax savings expert, and we specialize in hospitality industry, real estate industries, small businesses, professional service providers. And many of you, I do see many familiar names who has been with us in this journey of webinars since March 16. Well, the pandemic in US was announced on March 13th, and the lockdown was announced on March 13th. And I'm proud to say that we have been hosting webinars since March 16th, literally 3 days after the announcement of the lockdown. That time, no one even knew what this COVID lockdown is going to bring in. And and another announcement here, I'm very proud of my team and the hard work that we all have done. At the same time, thankful of my clients who voted for us. And I'm proud to say that we have been awarded one of the top accounting firm in the Lehigh Valley area for the Readers Ranking Award for 2020. And a little bit about myself, I have more than a decade of accounting industry as well as tax industry experience. And I converted our firm to this value-based service around tax planning as well as the business advisory about 4 years ago. And I'm very blessed to have my sister helping me in this family business, because together in the last 12 months, we have been able to generate tax savings of about $1.6 million for my clients. I'm a CPA, certified tax coach, certified tax planner, as well as certified concierge accountant. And I have some of the designations as a certified tax coach and certified tax planner, which only around 700 accountants throughout the US have. And there are only 2 in Pennsylvania, and I'm proud to say I'm one of them. And I have a deep passion to cultivate business solutions for my clients to help them build lasting wealth and live a family legacy. I say that most business owners, they come into the business to have a better quality of life or to be their own boss. And at the end of the day, in this journey, people get so much involved and they are focused on the top line revenue that people forget how much they are keeping in their own pocket at the end of the day. And I believe in, it's not important how much you make on the top line revenue, but it's very important how much you keep in your own pocket, right? How much you are saving for yourself, how much is your net worth at the end of the day. And that's where we come in place, because half of the problems in life will be solved if you had enough of money so that you can spend quality time with your family, right? If you have any questions, Taruna will be monitoring the Q&A again. And let's dive in. Well, while it looks like Biden is ahead and has been announced on major news networks, there are 4 scenarios that we have been planning for. This is the version 2 of the webinar that we had done a couple months ago. I should say actually in November, beginning of November. And now within a month, we have got more clarity. So I'm going to go a little bit more deeper on this time. We, as many of you know, we have been planning for unknown outcome, contested versus election. And what if Biden is elected and what if Trump is elected, right? And the problem is, we may not have the election results for the next few months, or I should say we do know a little bit right now, but we don't know the final results yet, and which presents problems, because in that particular case, we have to plan around all of these areas. If Biden is announced and he is winning, then what kind of tax strategy, tax changes are coming in? At the same time, when is that tax plan going to get implemented? Because there will be 4 different planning phases, which is 2020, a year of uncertainty. At the same time, some tax strategies that you have to utilize before the new tax bill is announced. We call it as pre-tax bill. Some of it after the tax bill. At the same time, 2022. So there's a lot of things going on. And Biden proposed tax policies. Well, whatever Biden has proposed is not an actual tax law yet. And the suggested changes were made to entice the voters to elect the campaigner. Therefore, key details have not been laid out or set in a stone. And most likely, the proposed policies must make it through the House of Representatives and the Senate before it's signed off by the president. So depending on who is ruling the House as well as who is ruling the Senate, the actual tax law could be, completely different. And additional details, that we are waiting on, depending on who will rule House and Senate, we will get more clarity on that. And if Biden is elected, when to expect enacted changes? Well, with COVID, we witnessed a rush order process on enacting the CARES Act as well as the Family First Coronavirus Response Act. Normally, tax legislative changes take a longer period to narrow down details before enacting it. And we all know how messy of a process this has been. One day you hear one thing on the PPP and EIDL, tomorrow everything is changed. Day after tomorrow, again, everything is changed. So in addition, it is also rare to see retroactive changes. However, it's not impossible. Therefore, for last few years, whatever elections we had, and what are the years when they make an election to go retroactive. So if we were to look here, Omnibus Budget Reconciliation Act of 1993, this act was signed on August 10, 1993 into a law, but it was made effective January 1st. Even though it was signed in August, they made it retroactive from January of that particular year. And that was a retroactive. Then if we look here, there's the Patient Protection and Affordable Care Act, which was enacted on March 23rd of 2010. It started, it went into effective since January 1st, 2013. And American Taxpayer Relief Act, even though it was signed into law on January 2nd, 2013, it went into effective the exact same year, one day ahead of it. So again, if this law is going to be made effective the similar way, we have to be prepared. We have to plan for pre-tax bill at the same time post-tax bill. And as we know, Tax Cuts and Jobs Act, CARES Act, and Family First Coronavirus Response Act, some of it are recent, but we all know it. It could go either side, or it is quite possible that some of the changes might be effective January 1st of 2021 versus some of the changes effective January 1st of 2022, depending on the situation. And with the proposed tax policy, there are many tax rate changes are about to be coming in. So some of them are corporate tax rate changing from 21%, which is the current law, going to 28%. Capital gains tax rate going from 20% to 39.6%. That's almost double. The top individual income tax rate going from 37% to 39.6%, which is 2% increase, almost 2.5%. And FICA tax, which under the current law was stopping at $137,000 at 6.2%, is going to continue over a salary of 400 plus. So if you are a guaranteed partner or a limited partner in a partnership, this is definitely going to impact you. So, this is something you definitely need to plan around on that side. Or if you are a W-2 earner who is making more than $400,000, this is going to impact you as well. The top effective rate on pass-through income, right now it is 29.6%, which is going to go to 39.6%. And the estate tax rates are increasing by 5% as well. Well, remember, This is just a proposed law, not yet passed, not yet enacted. So don't stress out too much. But more educated you are, more aggressively you can plan for it, and certain things that you can take into consideration ahead of time. Well, and also I wanted to compare between Biden and Trump. What are the areas of changes? So if we were to look at the corporate tax rate, Biden proposes increasing the corporate tax rate to 28%. Additionally, Biden proposes a minimum tax on corporations with the book profits of $100 million or more. At the same time, Trump is not proposing any changes on the corporate tax rate side, which is keeping it at 21%. And what will happen, I just want to give you guys a visual of a case study. If you have a certain level of income and the tax rate is changed from 21 to 28%, this is what we are looking for. Now, under the Tax Cuts and Jobs Act, they reduced the corporate tax rate to 21%, which Biden is planning to increase at 28%. Now, if you are a business owner, or if there is a business owner making $3.5 million in an annual revenue, the tax rate at 21%, they're paying $735,000 in taxes. If the same business owner with the Biden's proposed tax law with a 28% tax rate will end up paying $980,000 in taxes, which is an increase of about $245,000. Now, the planning considerations are very important here in this case. Consider taking in dividends of retained earnings before the end of the tax year to take advantage of the lower dividend rate. At the same time, consider legal entity changes from C Corp to S Corp probably to avoid double taxation at 28% and 39.6%. And also at the same time, you need to determine whether you want to make any changes in 2020 or 2021, because that's going to be very important here as well. Now, if we look at the capital gains rate or dividends rate, Biden's proposal would increase the top marginal tax rate on long-term capital gains to 39.6% for taxpayers earning more than $1 million annually. And as we see here, Trump has no changes in there. If at all, he's asking to reduce the capital gains tax rate as well. And here he's saying he would also eliminate the step-up basis tax expenditure that allows descendants to pass capital gains to heirs without tax. The top rate on long-term gains would nearly double, which is from 23.8% to 43.4%. That's almost double. Now, additionally, what Trump is saying on the other side, that he would propose cutting the maximum capital gains rate to 15% if re-elected, and his fiscal year 2021 budget proposal would extend the applicable Tax Cuts and Jobs Act provisions beyond 2025. Well, there are mixed of here, opinions here, I know, but again, I'm not favoring here any one of the presidential candidates here. My job as an accountant is to educate the business owners so that they can make the right decision and survive in this business and thrive in this business. Now, what it would look like raising the capital gains tax rate. Right now, we have 3 capital gains tax brackets, which is 0%, 15%, and 20%. And if Biden would increase the capital gains rate for higher income individuals making more than $1 million, with 1 million threshold, capital gains would be taxed at the highest individual tax rate, which is 39.6%. We don't have enough of details on the implementation of this tax increase, but a potential assumption in the deployment of this change would be to start the 39.6% capital gains tax rate for taxpayers making over $1 million, allowing a 4th tax bracket to the tax table. And for our assumptions, we have kept the 0%, 15%, and 20% rates added a 39.6% rate that starts at $1 million in income. And if we were to look here, side-by-side comparison, current law versus Biden's, so if it is someone who is married right now, up to $80,000 in capital gains, you're paying 0%. 80 to 496, you're paying 15%. And 496,000 plus, we are paying 20%, which is going to go here and increase. If you have more than $1 million in capital gains tax, you're looking to pay about 39.6% in taxes. And this could easily happen. Like I have one of the hotelier who is in California, who sold a hotel for about $2.5 million. And that hotel was built even before I was born. And the hotel was fully depreciated, which means there was no enough basis left in that hotel. And that full $2.5 million deal was 100% capital gain. And we helped her utilize a tax strategy where we can eliminate about $1 million in capital gains taxes. Not deferring it, not 1031 exchange or installment sales, completely eliminate, just utilizing a tax strategy, about $1 million in capital gains tax. If you are a real estate professional or someone who is very, really involved in the real estate and planning to sell something, or someone who is involved in the stock market and made a huge gain, in the past, it was okay with the 15 to 20%. It's still too high, but we specialize in the tax strategy where we can help you eliminate a huge chunk of your capital gains taxes. In the past, if you were okay doing 1031 exchanges, it was totally fine. Moving forward, 1031 exchanges are not going to be as productive because of this tax rate changes. And if the tax rates are about to increase from year to year, 1031 exchanges are not ideal, because what 1031 exchange is doing, it's just deferring out your taxes, not eliminating it, deferring it out. And as far as the installment sales are concerned, the founders of installment sales themselves are in a court scrutiny. And the way court case is going right now, it seems like it's going against them. So that is completely out of the question here. So, you have to really plan out with the capital gains tax rate. And if we were to look here with the case study, where Sally Field sold her business to Acme Industry for a net profit of $2.5 million, the gain from the sale will be taxed at the capital gains rate. Let's compare the results under the current law versus Biden's plan. Now, $2.5 million of capital gain under the current law, it will be taxed at $463,000. And under the Biden's plan, it will be $757,000, which is a whooping increase of almost $300,000 in taxes. And the planning considerations that we are proposing here is consider accelerating capital gains in 2020 if possible. Like we had another client who was selling their amusement park in Texas for about $7.5 million this year. And they had their closing date literally scheduled up for third week of January. With proper guidance, we were able to help him move his closing date in 2020. So he's about to close, in this week. And that's how he's going to pay capital gains tax at a lower rate versus paying it at a higher rate. At the same time, you can consider gifting appreciated assets in the future years, just so as to, not pay capital gains taxes. And if we were to look into the Acme Industries, we'll expect to see an increase in capital gains taxes under the Biden plan of $294,000. And this is how we have calculated our numbers. First $80,000 to $416,000 taxed at 15%, rest is taxed at 20%, then whatever is the excess balance, which is taxed at 39.6%. So that's how you are kind of looking at and calculating the difference here. Versus here, anything more than $496,000 is taxed at 20%, which is about $463,000 of taxes here. On top of this, you also have to consider whatever state taxes, whatever state you are in, that also plays a huge role here. Individual income tax rate. This is applicable to everyone, whether you are a business owner or not a business owner, applicable to everyone, right? Biden has proposed increasing the top tax rate back to 39.6%, where it's set prior to the Tax Cuts and Jobs Act. And Trump has mentioned the idea of new 10% middle income tax cut. Additionally, he's supporting extending the tax provisions under the Tax Cuts and Jobs Act beyond 2025. So if we were to compare individual tax bracket, current law versus proposed Biden law, right now the highest tax bracket is at 37%, which is about to go high to 39.6%. At the same time, if we were to look, the current marginal income tax rates are 10, 12, 22, 24, 32, 35, 37%, with thresholds for each of these rates varying by filing status. And no further details have been provided relating to this calculation. However, we are making an assumption here. The top tax rate of 39.6% will start at $400,000 in accordance with Biden theme of Joe Biden will not raise taxes on anyone making less than $400,000. So we are assuming this higher tax bracket is about to hit more than $400,000 income owners only. And if we were to look into this comparison, current law versus Biden, so we have here for someone who is a single taxpayer, we have a 35% starting at $207,000 in income, and 37% starting at $518,000 in income. Instead, we will not have 37, we will have 39.6% starting at $400,000 in income. So you see here 35% is up to $518,000 in income. It's increasing to $400,000. Now, if it is someone who is married and filing jointly, it's going to impact you even more. Because if we look at it, 32% for $326,000 to $400,000, there is no 35%, no 37%. It's going directly to 39.6%. So we have to look into case by case basis. What is the ideal situation to file joint, file it separate? And if we were to look here, an example, James Kirk receives W-2 income of $800,000. James also receives capital gains of $1.8 million. So his W-2 taxable income under W-2 tax under the current law is $260,000. Under the Biden proposed, it's $273,000, which means it's increasing taxes by $12,000. His employee FICA taxes are going to be increased by $24,800, and his capital gains tax is increased by $156,000. So overall, an increase of $194,000. With the current tax laws, when we were doing calculation, and we have done lots of case study here, out of the 12 month, an ordinary, I should say, an average American is working, they spend almost about 4 months of salary into taxes under the current tax law. With this, it's kind of looking like maybe 5 months of salary is going to go into taxes, or maybe 6 months. I don't know. I mean, for some of the higher earner, it's going to be a higher salary going into taxes. So it's pretty much you are working for the IRS, not working for yourself and your family. Well, consider, as far as the planning considerations are concerned, I would say probably consider accelerating income in 2020 through converting traditional IRAs to Roth IRAs, exercising stock options, or taking bonus early if you have that option, and determine how long you can defer the income and wait for possible tax cuts later. And this consideration may not occur for next 4 to 8+ years, or it could be even longer, because we all know, because of the pandemic, how much cash has been infused. So for at least next few years, tax rates are going to be higher than right now. Elimination of Social Security tax cap. Well, Biden has proposed eliminating the wage base cap of $137,000, which is what right now we have, on the taxpayers with income above $400,000. If your income, doesn't matter what sources, if your income is higher than $400,000, the Social Security base cap does not apply to you, which is what we have right now. And it does play a huge role when it comes to the taxes. And under his executive plan, Trump is saying, if employers, that he is going to allow the employers to defer the collection and payment of the employees' share of the FICA tax during the September to December 2020 period to January of 2021, with the promise to eliminate the deferred taxes if re-elected. To be honest, we work with many clients. At the same time, I'm kind of very involved with a group of lots of accountants and attorneys here. I've not come across a single client taking an advantage of this executive action here. And because, it's something like, if you're not withholding taxes for your employees right now, you're asking your employees to pay their taxes when it comes to filing their tax return, in April, they will have to fund this money out of their own account. And those employees, they cannot do it. So unless employees are willing to do it this with you, no employer can take the advantage of this executive order. So what is going to look like with 6.2% increase? If we were to take an example, right now, if you are making in salary up to $137,000, you're paying 6.2% of FICA tax, which is going to remain as it is. And any salary above $137,000, you are paying 0% right now. However, that's going to continue to be same. Again, we are assuming it. We don't have much clarification on that yet. But if your salary is over $400,000, you will end up paying, again, 6.2% of any salary excess of that amount. Again, some of the planning considerations that I would recommend here is checking in if you have any option to defer your compensation, or if you can take the bonus in 2020 instead, if that option is available, or maybe maximize your retirement contribution and try to stay below $400,000, getting non-taxable fringe benefits from your employer, and that might be very helpful in that regards. So if we were to look at the elimination of the Social Security tax cap, here, if we are looking here, so if you have wages up to $300,000, it's kind of, there is no difference. It's going to remain as it is. Anything above $400,000, as you see here, it's kind of increasing substantially. And there are people who does make in salary up to $450,000, $500,000 a year. I was actually talking to someone else, and his general manager made $700,000 in salary, and he's really afraid of salary. I'm like, afraid of taxes. I'm like, you should be afraid of taxes. That's pretty high amount in taxes, right? Top effective rates on pass-through income, which is about to change from 29.6% to 39.6%. So if we dive deeper in right now, currently the unincorporated businesses are eligible for a 20% deduction based on the QBI. And the Biden plan proposes phasing out this deduction above $400,000. So what it really means, if your income from, doesn't matter what sources, W-2, interest, dividend, capital gain, your business profits, if your taxable income turns out to be more than $400,000, you don't get any QBI deduction. And for many of the business owners, this is a deal breaker because QBI deduction is pretty hefty, pretty high amount. And we do not have the detail about this phase out, and have made the assumption that the QBI deduction is completely phased out after $400,000 in income. And the QBI already phases out for specified service trades or businesses already, as we know. And this new limitation would most impact those businesses with high W-2 wages or with businesses that have significant unadjusted basis immediately after the acquisition. So Louis Jefferson runs a dry cleaning business. The business is currently organized as a Schedule C, which is a sole proprietorship. She is tracking to receive 1.2 million in gross income during 2020. And she expects to pay about $400,000 in employee wages this year, and will have $150,000 in other expenses. So her net owner income would be about $700,000. Louis would like to know what her tax bill would look like under the current law compared to the Biden's proposal. So before doing any analysis under the current law, gross income of 1.25 million, employee wages, other expenses, and owner's net income. These are the key areas which plays a role in your section 1998 deduction or your QBI deduction. So what we are looking here is under the new law, what is it going to go here is one half of the self-employment, which is taxed at $17,000. Here it is going to be $33,000. Standard deduction, which is 12,400, assuming this person is a single. QBI deduction that this person is getting is $136,000, which will be phased out because the business income is more than $400,000 here. And then the taxable income here is 533, which goes higher again. Not only this person is losing out this QBI deduction, but taxable income is also higher, which increases these taxes here and the self-employment taxes and the additional Medicare taxes. So the actual tax difference, we're talking about $84,000 higher in taxes compared to what it was before. That's a pretty heavy number. At the same time, estate tax rates are going from 40% to 45%. I'm going to skip some of these slides, but what we are looking here is if there is an $11 million, up to $11 million, there is an exclusion under the current law. But with the new law, it's going to be $3.5 million exclusion, which is, they're reducing this limit by $8 million. So probably consider gifting of income producing assets right now, or consider business valuation when assets value may have decreased based on the COVID, or consider potential family debts that may occur in the near future. These are the areas, where it can be planned out. And again, I don't know about the other accountants, but in our case, I partner up with your own estate attorney, or if you need if you don't have any and you need someone, we go and find it out for you based on what state you are in, so that you're not talking and explaining to two or three different people. I partner up with your financial advisor, your tax attorney, at the same time, your estate planning attorney, so that, we are on the same page and you're getting the maximum benefit out of the deal. I'm going to skip some of these slides here. Biden proposed tax policy on the itemized deduction. So here, right now, for $150,000 in income, for $400,000 of AGI, gross itemized deductions are $150,000, which is going to remain as it is. However, if your AGI is more than $400,000, which is, as you see here, the itemized deductions are reduced by a huge amount, $47,000 here, $57,000. With taxpayers making more than $400,000 in income, tax deductions will be capped at 28 cents per dollar. So that's kind of a huge, drawback here with the reduction in the itemized deductions. And the retirement accounts, if it is someone who is making $40,000 in wages, they are in 12% tax bracket. Under the current tax law, they are paying $6,000 of deductions, and the tax benefit under the current tax law is $720. The tax benefit in the Biden plan, with the Biden's plan, is going to be $1,500, which is a difference of about $840. So it looks like up to a certain extent, this is in a favor, but then it's kind of after, more than $175,000 in wages, you tend to see, how the benefits are being lost. So it's retirement, refundable tax credit for the retirement accounts are beneficial for, wage earners below $175,000, or I should say $170,000. Above $175,000, it's not as favorable. At the same time, there are many other areas of tax law where there are differences and where it could impact many people in the country this year, which is earned income credit, child and dependent care credit, child tax credit, first-time home buyers credit, renter credit, and Made in America credit. So there are many of those areas as well. And I'm going to skip a little bit so that we can cover the top 3 tax strategies as well. And there are many other additional proposals in place already. Additional tax policy proposals for the real estate. The Biden plan has called for the elimination of the unproductive and unequal tax breaks for real estate investors with income over $400,000. And the specifics of these details are currently unknown, but it could impact certain existing tax strategies. And this includes 1031 exchange, or the investment in the opportunity zones might not be as favorable under the Biden's tax proposal as they are favorable in the current tax laws right now. When it comes to the entity optimization, Schedule C to S Corp, under the current law, changing from Schedule C to S Corporation will usually save you money on taxes. However, I do not recommend making a shift unless you are making, more than $50,000 in net profits in the business. When you have that, when you're making more than $50,000 in net profit in the business, it kind of makes sense to look into what are the other ideal best entity options available. Again, this is something when I speak to lots of prospects, and I ask them, on what basis did you make an S election? Most of the time, because my friend was doing it, this is something I was told by someone else, and this is how prior business owner operated. You can't take the medicine based on someone else's disease or someone else's health condition. You have to evaluate what is best for you and for your business, not for someone else. Now, what is a good strategy under the current law can be more powerful strategy under the Biden plan. And since the Biden plan will be imposing self-employment taxes again after $400,000 in wages, switching to a S corporation when the Schedule C has a net profit of above $400,000 generates even more tax savings than the under the current law. Under the current law, $50,000 and above in net profits, S corporation makes more sense. For the new law, it will make more sense when you have the net profits of more than $400,000 in the business. Well, entity optimization and owners' reasonable compensation. There are additional tax policy proposals here. The Biden plan has called for the elimination of unproductive and unequal tax breaks for real estate investors with income over $400,000. The specific details, again, are currently unknown, but it could impact certain tax strategies. I think this is a duplicate, which I think I have already covered here, and here it is. Schedule C to C Corp under Biden. I'm sorry for that. C corporation income is taxed at the C corporation level, and net business income is not taxed on the individual level as it is with a Schedule C S corporation or partnership. Currently, C corporation tax rates are at 21%, and the Biden will increase it to 28%. In addition to the increased tax rate at the C Corp level, the owner of the C Corp could potentially be subject to increased taxes on the income they take out of the business. So again, these are kind of the area where, if you're a client of ours, please don't worry about it. We are closely monitoring what is the best structure for you. If you are someone else, I would say stay in touch with your current accountant because they can guide you when to make that switch. C Corp to S Corp, or C Corp to Schedule C to C Corp, Schedule C to S Corp. This is something you have to closely, because it's going to make a huge impact. If not the right decision taken in time, then you might end up paying high taxes. And owner's compensation for the C corporations. Generally, income is taken out by the owners of the C Corp as either wages, dividends, or some combination of the two. Wages over $400,000 will be subject to self-employment taxes, and this will happen at both the C corporation as well as on the individual's W-2. And the dividends can also be taxed at 39.6% if you're taking out the dividends from your C Corp if the owner's income exceeds $1 million. So income from within the C corporation or taken out of the C corporation may be subject to additional tax under the Biden plan. And if you're planning to make a switch from S Corp to C Corp, again, hold on, don't make the changes right now because we don't know what's going to happen. Because you may wish to offer more, free fringe benefits or accumulate money within the corporation for a larger project, or you can easily raise funds for the expansion, such as through stock offering or going through the private equity and all. I'm going to skip some of this. I'm just afraid that we don't have enough time. So this is something important. If you are someone who is taking high distributions from the business, being an S corp or partnership, and without your knowledge, your accountant is adjusting it as a shareholder loans, this is something you have to be absolutely be careful about. Owners of a C corporation or an S corporation sometimes removes the excess cash by means of a shareholder loan rather than from some other transaction such as the dividend or wages. And the IRS is concerned that such transaction is merely a means of avoiding normal taxation. And if you are doing this, then you should make sure that it is an actual loan. You have the promissory note and it is a bona fide promissory note. You're showing the payment and everything, For the IRS, a loan by a corporation to the corporate officer should include the characteristics of a loan made at arm's length. That is, there should be a contract with a stated interest rate, a specified length of time for repayment, and a consequence for failure to repay the loan. And collateral would also be an indication of a loan. So if you put your business as a collateral and get a loan, that is considered as the loan as well. Let's move on. The tax savings. I'm going to skip some of the slides here and go over what is tax planning. If this is something, you're not aware what is tax planning and how it is done, it's not something that can be done after the year end. After the year end, you can only do, the preparation of the tax return for submission to the IRS, which is what most accountants throughout the country does. The tax planning is something has to be done before the year end, and it is the process of looking at person's life, business, and regulatory requirements, as well as their past, present, and what are their future goals to legally reduce their taxes. Because a right tax planning strategy is something which will not only reduce your taxes today, but will reduce your taxes for future as well. And if you are curious why business owners have been asking about 101.5% tax bracket, we did a case study of a business owner who would be in San Francisco, how they can end up paying 101.5% in taxes between FICA, Medicare, C Corp, and whole of a bunch of these areas. And that does not include any sales tax or property tax at all. So that those all taxes add up to 101.5%. And regardless of who wins, as we all know, there has been massive deficits. Money has been printed. Pandemic relief or stimulus packages has been issued, and tax changes are coming as part of the presidential election. So we are absolutely expecting, that tax rates are going to go high, and we are highly focusing on this too for now. And let's go. If Biden were to win, you have to look at all of these deadlines here and plan accordingly. 2020, plan for uncertainty. 2021, plan for pre-tax bill. 2021, planning post-tax bill at the same time for 2022, planning for the next year. And for 2020, as we all know, it's going to look like an iceberg, what you can think you can save in taxes versus what you can actually save with tax planning, with the new COVID bill and potential changes in presidents. So if you have never done any tax plannings before, this is the year that you must do it. And you cannot, afford to lose out on the tax planning. And when we do the tax planning, we cover all of these strategies, which is deductions, legal entity structure, retirement planning, insurance and asset protections, legal loopholes, Tax Cuts and Job Act, Family First Coronavirus Response Act, and CARES Act updates, as well as the advanced strategies, industry-specific strategies, exit and capital gains. And how I got started was growing up, I watched my father struggle with succeeding in his businesses due to lack of financial advice level without any taxes. So not going into too much in details, but if you are looking to implement any of these tax strategies, I'm planning to host probably next week or, before next week or the week after, one day webinar kind of event where I will be going in detail, going over all the tax strategies at the same time, going and reviewing your last 3 years of tax return and helping you maximize your net operating loss deduction or any mistakes or anything that is available to you to utilize at this point. And I will be giving you out all the implementation tools and everything like that. And this webinar is going to be only by invitation only. It's only for the client who are engaged in the tax planning services with us. And you will have these tax strategies to utilize for 2020 tax year as well as 2021. And as far as the 2020 tax planning is concerned, we are not accepting too many clients on that side. And I do have a very limited time available on my calendar at the moment. But at the moment, I can only accept 2 more clients before I stretch out my team. And I don't like to stretch out my team too much. So for 2020, we still have the capacity to accept 2 more clients. As far as 2021 is concerned, for the month of January 2021, I still have the capacity to accept 9 more clients. And whoever is joining between 2020, whatever days remaining in this year, in January, we will be helping you whatever tax planning strategies can be utilized for 2020 right now. And that's why I'm coming up with the webinar kind of an event where I will have at least 5 people, if at the max, only 5 people, where I will help you one-on-one going over all of these tax strategies and help you implement it so you get to learn from questions of one another. Going briefly over the new draft bill that has been issued just a few days ago as part of the economic stimulus package of COVID-19. And if you need the link to the bill, just let us know in the chat box and Taruna can put in the link. The two additional draft bills have been released for the economic stimulus due to COVID-19. Remember, this is not a law. $300 billion for the second round of PPP loan, as well as the EIDL grants. So EIDL $10,000 grants are coming back. It also includes a loan forgiveness process as more simplified for borrowers under 150K in loans. Extension of unemployment assistance for 16 weeks with a supplemental $300 per week again. Extension of student loan forbearance through April 1st, 2021. Additional $35 billion in healthcare provider relief funds, including $7 billion for rural providers. $25 billion for emergency rental assistance and extension of eviction moratorium through January 31st, 2021. So there are a whole bunch of things coming in. And, $10,000 EIDL grant is coming in as well again. So you have to make sure with the first round, there was such a huge rush to get all these benefits. Make sure that your financials, your financial statement and everything is prepared and ready ahead of time. You don't make the same mistakes you did it in the first round. Some of these things are very easy to apply. And certain things which are very easy to do are the ones which are very easy to screw up. I come across still many clients, or I should say many people, many business owners who has not received their EIDL loan or EIDL grant at all because they made a mistake or they screwed up. So, make sure you work with the correct professional. As far as the PPP is concerned, internal record keeping will be required for the PPP loans from $150,000 to $2 million, but it's not required to submit for the forgiveness approval. You just have to keep it in your records in case you get audited. PPP choice of seasonal business can choose 12 weeks time period in 2019, and ability to apply for the second draw of the PPP loan for businesses with the 300 employees or less, or 30% decline in revenue in any quarter in 2020 compared to 2019, and is not considered a public company. Simplified option 1-page application for forgiveness for loans under $150,000. And biggest Christmas gift from the Congress is the PPP expenses will be allowed as a deductions for tax purposes. Again, deductions for tax purposes when used for the PPP loan. If forgiveness is approved after the date of the enactment of this new act, again, you can look at the page 13 and 14 of the bill. This subsection shall only apply with respect to a loan which forgiveness is provided after the date of the enactment of this act. What it means, if you have already applied for the forgiveness, this rule doesn't apply to you. You cannot take deduction for the tax purposes. But if you have not applied for the forgiveness and you still have yet to apply for it, this applies to you. You can reduce your expenses for the tax deductions. Again, this is just a draft. It's not a law. And it's about to pass probably tomorrow. And it is quite possible between the time the draft was issued and the law is passed, there could be minor changes. So I'm hoping, crossing my fingers, that we find out about this final law by tomorrow or latest by Saturday. Well, next steps. If you are looking to implement any tax strategies for 2020, we have spots for 2 clients to do the full tax plan strategy, or in a webinar fashion, only 5 clients at the moment. Not more than that. I cannot do more than 5, more than 1 webinar. So this is only 1 webinar that I will be doing for that. At the same time, if you're looking for tax planning strategy session for 2021 or cash flow forecasting and budgeting to help your business plan out your cash, we can help you in 2021. Any other question? Oh, yes, Taruna, I think someone just sent, a couple of people actually sent me a question about how they can schedule a meeting. Can you post the link in the chat box?
Okay, so I'm going to paste that link, but do you want to take some questions?
Yeah, I'm open. Do you have any questions?
Give me 1 second. Let me just put the link to schedule the meeting.
I really apologize, everyone, for going this long. I know there were a lot of things happening here, but I really appreciate everyone hanging out for a couple extra minutes. And, if you're running late, probably you can drop out, but I'm going to cover a few of the questions. And if I could not catch your question today, I will reach out to you and send you an email with the question. So that way your question is answered. Taruna, do you have any questions that you want to cover?
Yeah, so here is first question that I just got. It's interesting, and I think many people might have this question, and if they did not ask, probably they should be asking this one. So my accountant never suggested me any tax strategies that will even save $100,000. That's really upsetting. But so I think he is costing me more by preparing my tax return. And if I want to take advantage of this planning, can I do it anytime before March 15th?
Very good question. And I can feel your pain here. And I'm sorry to hear that. You absolutely deserve better service. And you owe it to yourself. You owe it to your family because, because the taxes is something, the number 1 biggest expense for most business owners. And because if you are spending this expense at a higher level, your net profit is less, your take home money is less, your employee are getting less paid, and you're spending less time with your family. It's a lot of areas get impacted by just one thing. So here's the thing. Whatever tax strategies that I'm recommending is backed by IRS tax section codes or the IRS court cases. There is nothing here that I'm saying which is off the air. And I do deliver the written tax plan with reference to all the IRS tax section codes. So I'm confident about what I'm doing. All the other accountants, I'm pretty sure they are good. It's just that not everyone is doing the tax planning. They're just doing the compliance work. Again, if my dad did not suffer in his both the businesses, I would not have been doing this. Because he suffered, and as a result, the whole family suffered. That's the whole reason we opened up these services. So as far as the implementing tax planning strategies are concerned, I would say some of the tax strategies can be implemented before 31st December, have to be implemented before 31st December, because on 31st December midnight, most of the tax deductions are lost. You cannot go back and recreate bank entries. You cannot go back and recreate, some certain proofs and stuff like that. So you have to implement certain tax strategies. However, there are certain tax strategies which are available even after the year has ended. So, I mean, I do offer complimentary tax strategy session, and this particular strategy session is absolutely free. If you want to schedule up a session and probably send me a copy of your password protected tax return, I can give you more information on that. And, so that I can probably review it and, guide you on what are the best options. Here's the thing, many tax accountants are not really aware of net operating losses and stuff like that. I reviewed someone else's last 3 years tax returns about 2 weeks ago. Turns out he had about $800,000 in net operating losses, which he did not know how to utilize in his best interest. We amended his 2019 tax return, and we were able to get at least about $187,000, roughly $187,000 in a refund from the prior year's taxes. So this is very powerful.
200,000 plus.
It was 200. I roughly remembered it. I'm like, I thought it was 187. I didn't want it to overquote. But it's a pretty high amount of tax refund that he got for the taxes he paid from 2015, 16, 17, 18, all those prior years. That's a pretty good amount. For 2020, you do have that option as well. I don't know after new president is elected and with the new tax law, you will have this option or not, but this is a big deal. There are not any other questions besides
Yes,
this?
but just what you say, I just want to add one thing. We are very confident, like if someone is our client, we're very confident in saving future tax liability. So we're not worried about future tax liability. However, our best bet is to go back and recoup whatever you paid in the prior, because there is no way you can recover what you already paid. So that's really important. This client would have never received that 220,000 that he paid over past 5 years. So which was like, it was a big deal. So next question I have here is, my accountant suggested me to take just distribution out of business whenever I needed money. Isn't it that easier compared to using these strategies?
Easy things comes with a penalty. If it was that easier, wouldn't all the accountants will suggest you to do this rather than putting in the shareholder loans on your balance sheet? I speak to so many business owners, they have no idea what that loan is and what it really means in their books of accounts. So I don't know about other accountants, but I like to be very conservative. I like to maximize on the tax benefits, but at the same time, I don't like to open up doors for any inquiry or penalties and stuff like that. So I would say you need to do proper tax planning on that side. As long as you are taking a reasonable compensation from the business, okay, a reasonable compensation, which is backed by a thorough study, Department of Labor data, the job and responsibilities you're performing in the business, and those kind of things, I would not really worry about the distributions. If you're not taking reasonable compensation and taking, very high distributions, you should absolutely be worried about it, because you might end up losing completely your S corporation status. And this has happened. So you might end up losing your S corp status completely. Any other question?
Another thing I want to add here is, if you just take too much distribution, it affects your basis behind the door, which no one keeps track of it. And when it comes time to sell your businesses, it really screws up and increases your tax liability. So when we do tax planning, we look at your current tax situation as well as how it will impact your future tax liability, which is very important. We don't want you to be in a situation where your future tax will be high just because we did something in the current year. Okay, the next one. I don't think my accountant knows these strategies. Can you help me?
We can absolutely help you. Here's how I work, because I do know there are so many accountants who don't offer the services. So I provide the tax planning as a standalone service. So if you have an accountant, you really like to work with them for the accounting and tax preparation, we can design the tax plan for you. We can help you implement it correctly. And if you want, you can take it everything to your accountant. They can prepare your tax return as usual and just go from there. Or we can design a tax plan, and if your accountant is confident enough to implement it, they can implement it for you. So whichever way. At the same time, one of my career goal right now, and which is something I'm working on, and something about to we are about to announce in 2021, is we are starting a program where we will be training other accountants throughout the country on how to offer this kind of tax planning services. Because it's my biggest goal that I want business owners to be building their wealth as well as creating lasting family legacy and living their life to the fullest extent. And I can only serve my purpose if we can educate other accountants on these tax planning strategies. But a good question on that.
So next one is there any geographic limitation to be your client for advising and or accounting?
Not necessary. So one of the things I would say, we have been on cloud and serving throughout the USA since last few years. Pandemic just started in 2020, but we have been using Zoom and all of these resources for years. And in fact, my team is based throughout the USA as well. Like one of my recent hire, she is based in California. And one of my own sister, who is a CPA as well, she is based in Australia, as well as I'm in Pennsylvania. Taruna is in New Jersey. No, you don't have to be in a specific geographic location. You can be anywhere in the United States, and we work with only the business owners or high net worth individuals making $400,000 or more in income, or if you are someone who are starting new business or in a startup phase, but you expect to make about $300,000-$400,000 in revenue in next 2 to 3 years, we work with you guys. And here's the reason why we have decided to make income as the limitation here is when you are making higher income, you are in a higher tax bracket. Higher the tax bracket, higher the taxes, and there is more opportunity to save money on taxes as well. At the same time, you get the highest return on investment. So we only work with the business owners in the higher income level. From time to time, I have accepted some clients even with a lower income level if I feel very connected with their business. But this is something you are going to get the higher return on investment if you are above certain level of income.
Okay, I think the next question is along the same line. I'm from Florida. Do you work with clients in this state? It's one of the very tax-friendly state though.
It is one of the very tax-friendly state, and I do have client right now in Florida as well. We have clients in Maryland, California, Texas, Florida, Kentucky, many states, New York, Pennsylvania, New Jersey. We do have clients in many states, and we do work in that. Any other question?
The last question, I think you did answer this, but they just need clarification on taxability of PPP loan. So I think it just goes by when you apply for PPP forgiveness, and it depends on the finalization of this second stimulus law that's coming up.
Yes, absolutely. Alrighty, well, Taruna, is there any other question besides that?
No, I think that's it. Those are good questions. So thanks for asking.
Good questions, and thank you for asking. I don't have at the moment our webinar date planned out for the next webinar. Usually I announce the next webinar date already during the meeting, but you will hear back from us. And thank you so much for joining us today. And I wish you all happy holidays. Bye.
Bye.